Good afternoon, ladies and gentlemen, and welcome to the TRANSENSE Technologies results presentation. To start with, if we could cover a couple of housekeeping items. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via transense@walbrookpr.com. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that this presentation is being recorded. Now, I would like to hand you over to Executive Chairman Nigel Rogers and Chief Financial Officer Melvyn Segal.
Thank you very much, Tom, and welcome everybody to the seminar. I hope that you all enjoy it and get something out of it. I think we've got a good attendance today. I would assume that's a mixture of existing shareholders who know the story well and perhaps some new people who don't. So we'll start off the presentation with a recap for some, but it'll be an overview for others. So I will start off by just giving an overview of the company. The company's been listed on AIM since 1991. Current market cap at a share price of £1 is about 16 million. It's just about 16 million shares in issue. There's a list of major shareholders there, more than 3%. The most recent of those being Dowgate Capital, who've accumulated 4% over the last few weeks. The board of directors, myself as executive chairman, Melvyn, who you'll hear from later, as CFO. Ryan Morn was recruited as business development director, and he's been pulling up trees as far as the new prospects, and you'll see some information on that later on. You know, terrific amount of extra customer engagement over the last 12 months. The most recent addition to the board is Steve Parker, who is a very experienced non-executive director, spent most of his life in large engineering consultancies, and a very talented individual, and again very well connected. He joined us as a non-executive director a few weeks ago, and people will see that he also started to buy some shares. He bought a few shares this morning, and the board is completed by Rodney Westhead, who is also a non-executive director. Rodney's been with the business for many years and has signalled his intention to retire from the board over the next 12 months or so, and will be recruiting an independent non-executive director to replace him. The senior management team is led on site by Andy Bullock, who joined us just over a year ago as technical director and runs the day-to-day operations of the SAW business. And again, he's been an excellent addition to the team. And I think we'll be talking a bit more about management as we go through. You can see also there the revenue, adjusted EBITDA and adjusted profit before tax graphs for the last 3 years, all showing strong progression. We'll be talking about the financial track record up to 2023 in the context of signalling midterm financial goals for 2023 to 2028 later in the presentation. And as you can see, the share price being shown there relative to the AIM index has really begun to respond to some of the good news that we've had in the marketplace over the last few months. Moving on to the business, we're going to be talking primarily about two operating businesses today. TRANSENSE, which is the design and supply of advanced sensor solutions for accurate non-contact measurement of torque, force, pressure and temperature. For the uninitiated, torque is the twist on a shaft in an engine connected to wheels generally, and is very important in terms of being able to apply power to convert that into speed. Our SAW technology is very much an enabling technology. It improves control and efficiency across a whole range of measure arms in several different applications, and we'll be talking about some of those in depth today. The second business we'll be talking about is TransLogic. TransLogic is the developer and supplier of smart connected tire inspection tools, so handheld tools, mostly for the collection of pressure, tread depth, RFID, in truck and bus markets. So big fleet operators use our equipment. There's a lot more information about both of those businesses on our website for those who would like to see them, including some very interesting video demonstrations. We deal with a lot of very big companies, and there's just a selection here of some of the major customers that we work with. Some of those will be familiar to people who've seen these presentations before. Frustratingly, there are 4. They're just a sample of 4 of perhaps 34 companies that are currently under NDA for whom we're not allowed to use their names in these presentations. In fact, although that might sound a little disappointing, it's actually good news, because what that means is that they think that the use of our technology is giving them an edge in their marketplace, which they don't at this stage want to reveal to their competitors. So actually, in many respects, it's a signal of our success if large companies don't want to publicize too early that they're working with our technology. Working with big companies is great. They have scale, they have reach, they have market access. It's also fair to say they don't always move as quickly as TRANSENSE does as a small and nimble technology supplier. And so, for those reasons, most of our business takes the time to win, but then once it's won, it's sticky business and it tends to stay as well. Many who are watching will also be familiar with this slide. So this page explains the drivers and the reasons why our 4 target markets for SourceSense emerged as being primary opportunities: aerospace, industrial machinery, in which we include off-highway vehicles and robotics, electric motors and drives, and the performance automotive arena, motorsport and high-performance vehicles. It's in these spaces where we see opportunities to develop applications for our SOAR technology, because our SOAR technology will meet an unmet need. So, in many of these sectors, people are already measuring torque, particularly in aerospace and robotics, and obviously in performance automotive as well. They're already measuring torque, but our own system of measurement provides significant benefits over and above the technology that they're already using, either because it offers an opportunity to save cost or improve performance, usually both. And in each of these sectors, we now have strong market engagement. We're going to be talking about some statistics in terms of the number of customers engaged in each of these markets and the level of engagement that they're at. And we're starting to see real market pull from those customers. The third business segment, which we'll be talking about more briefly than we have in previous periods, is the Bridgestone iTrack transaction. So for those who aren't familiar with the company, we had another technology, iTrack, which was developed under the Translogic brand, but was sold in a licensing transaction to Bridgestone Corporation in June of 2020. So we're now 3 years into that 10-year license period. The license expires in 2030, and the annual license income has increased from 800,000 in the first year to 2 million in the third year. So in FY23, we've collected 2 million of revenue from that. There's another 7 years remaining, and later on in the presentation, we're going to be talking about what we think the prospects are in terms of the growth rate in unit volumes during the remaining 7 years, set against the agreed unit rate reductions which take place in 2025 and 2027 under the licensing contract. So we'll be talking more about that. Melvin will be talking more about that during his presentation of the figures. Again, just to complete the overview, these 3 charts show some interesting segmental information. On the left-hand chart there, you can see the growth in revenue, which has gone from about 1.75 million in 2021 to 3.5 million in 2023. Those are financial years ended June. And you can see how that segmentation works. Obviously, the single biggest contributor at the moment is still the iTrack royalty in grey there, but you can see the underlying growth in the 2 businesses which we run day to day, Translogic and SourceSense, are both making a significant and increasing contribution. And we'll be talking about how we see that growth rate progressing in the next 5 years later on in the presentation. The center donut chart there shows SOAR revenue split by market segment. So you can see there SOAR revenue for FY23 was largely derived from aerospace and motorsport. although beginning to start emerging in electric motors and drives. And this is a donut chart we'll be continuing to show in future presentations to see how that evolves. And then on the right-hand side, another donut chart there, which shows the geographical split of revenue for SAWR and TransLogic combined. And again, I think that shows that we're a very well spread business here with lots and lots of exports. 75% of our revenue exported. So next, what I'd like to do, now that we've either recapped or provided an overview, is to talk about the development of our strategy and the key implementation points over the last 12 months. I think in the last 12 months, we've made tremendous strides forward in terms of implementing our strategy. I want to talk first of all about TransLogic. So TransLogic is the business exposed to the truck and bus market, and the logistics market has been growing very rapidly indeed. There's been all sorts of major growth drivers. We all have more and more purchases delivered to our doors now, and distribution of products around the world is a very high growth market. The logistics market's growing strongly. However, it's also extremely competitive and very much cost driven amongst the operators. And in addition to those cost pressures that they see in terms of competition, they're also seeing an increasing regulatory burden in this sector, particularly driven around road safety. I mean, anybody who drives around the motorways will still see shredded truck tires on the side of the road, and it is still the single biggest cause of death on the motorway network, tire failure. And for that reason, it's very much in focus amongst the safety authorities, and increasing amounts of regulatory pressure to both measure but then also to keep digital records of proper inspections is becoming embedded into all sorts of regulatory requirements for truck and bus operators, all of which is much more efficiently done using our equipment than using traditional handheld tools and manual record keeping. Over the course of the last 12 months, we've actually spent a lot of time talking directly with fleet users. People familiar with the business will know that a high proportion of our sales in the past have been sold through the major tyre producers, where we have very good relationships with Bridgestone, Goodyear, Continental, and Pirelli, just to name a few majors. But we're increasingly now engaging in conversation with fleet end users, so going through the middleman to speak to the end users to understand what the major drivers of decision making for them are. And what that's led us to believe is that actually the market is significantly bigger than we perhaps might have otherwise thought. And we're making an estimate in this presentation, which is the basis of our strategic decision making in this business, that it is potentially a $25 million market here, of which we're currently making sales of around $1 million. We have a very strong customer base upon which to build in the tyre majors, but we think that direct fleet opportunities, both in the UK and overseas, will help to pull significantly more volume through. We're working closely with fleet software providers in order to be able to offer a combined package of both hardware and software, and increasingly try and move that to a recurring revenue model, incorporating software as a service rather than purely a hardware sale. And we think that these initiatives will move this business forward very rapidly over the next 2 or 3 years. So much so that we've recruited a dedicated business development leader. We're delighted that he will be joining us very soon. He's currently on garden leave from his current employer, but he'll be joining us very soon. And during that recruitment process, we were very pleased that actually his views accorded very much with those that we had formed in terms of the market potential for our products and the best routes in which to attack those markets. And so I think we can expect some great things from TransLogic over the next couple of years. Moving then to TRANSENSE, this is quite a busy slide. There's a lot on it to digest, but the 3 bars at the top there show the key industry drivers in the aerospace market, which we think provide opportunities for us with our SAW technology. So firstly, conventional jet engines generally would not use a SAW-based sensor. and there are other sensors are available which would generally be specified in conventional jet engines. However, the pressure to decarbonize in this sector are very strong, and there is a lot of development work going into more efficient fuels and more efficient engines in order to burn less fuel. And we believe that that will create opportunities, particularly for example, the CFM RISE program, which we're involved with as the development partner. We think that specifying SAW technology on open rotor engines rather than conventional jet engines will be one of the enablers to unlock their use in future. The second bar there we talk about is the move towards hybrid and hybrid electric engines. And I think that we'll see increasingly, there are many development programs now to try and bring those engines into use, both for urban air mobility and also for regional jet traffic. So there are some very favorable industry drivers which are beginning to show a lot of development activity, and that's creating end user pull to come and engage with us to understand and try and work out the best methods of applying SAW technology in the aerospace industry. Historically, our engagement has already been strong in helicopters, and particularly in military helicopters. People will be familiar with the GE T901 program, which was specified in 2016. But moving forward, we see lots of other opportunities in aerospace, not only in the engine, as I've talked about with hybrid generation, for example, but also in mechanical assemblies like electric actuator for force and torque monitoring of electric actuation for flight surfaces, and also open rotor engine torque. So we're already working on development programs in that area in the 2023 column on this chart, and moving towards 2028 we see more opportunities again in electric propulsion and potentially in braking systems and elsewhere on the aeroplane. So I'll be talking a little more about the companies that we're engaged with numerically and the level of engagement going forward in the aerospace industry in 2 or 3 slides time. But in the meantime, on this page, you can see it's an enormous market and forecast to grow very strongly over the next few years. And we estimate that by 2030, we could have as much as 5 to 10 million of revenue in the aerospace market, potentially coming out of the provision of engineering services and component supply. I'm going to move on now to industrial machinery, and particularly a subset of the industrial machinery segment where we've seen a lot of success over the last 12 months, and that's in robotics. And I'm talking specifically here about larger manufacturing robots, the type that are increasingly going into connected factories under Industry 4.0. It's a sector which is undergoing very rapid growth. Automation is a key feature of manufacturing across a whole range of industries. And there are some very big and successful companies in this marketplace to whom we're talking. The market for torque sensing in robotics is perhaps easier for us to attack than others because most robots already have a live torque measurement being used using conventional either strain gauges or displacement sensors. So we're trying to displace or replace existing technology here rather than trying to demonstrate a need to measure torque in the first place in the robotics marketplace. And there are some very significant advantages of using SAW technology, particularly around load capacity and speed and productivity of the robots. Our technology can be used without changing the features of the shaft within the robot. Traditionally, robotics have had to use more flexible shafts in order to gain an accurate torque reading, whereas our torque sensors will work even where the shaft is very stiff, and that means that it can work more accurately with a SAW-based sensor. This industry is currently worth about 300 million a year, potentially forecast to reach 650 by 2028. So again, a very big market, and one in which we're talking to 2 or 3 industry leaders. And we estimate an addressable market for our own business here of around 50 million. So a very significant space. I'm going to talk next about high-performance vehicles. Specifically in motorsport, people will probably be familiar that we have a partnership with McLaren Applied as a strategic partner to sell into motorsport, and they have been putting a lot of effort into casting their net somewhat more widely into different race series with a great deal of success over the last 12 months. We've seen good revenue growth through McLaren Applied in the last 12 months and a number of opportunities emerging now for FY24. So we're feeling very positive about this as an industry space. Our technology is proven, and as many people will be familiar, motorsport is often a marketplace in which you can provide a pathway to high performance vehicles for road use as well. So, a very interesting space for us to prove our technology. We estimate an addressable marketplace for us in motorsport exceeding $20 million a year. So again, although it's a niche market, it's certainly large enough to deliver plenty of growth in our business over the next few years. Turning lastly to electric drives, this marketplace is perhaps less developed than the others, and the reason for that is because traditionally torque sensing has not been used to control motors. Generally speaking, motors have used torque estimation rather than accurate actual real-time torque readings in their engine control unit. And so proving the use of SAW technology is a slightly longer game here. However, it's also, I think, an extremely lucrative one. And so for that reason, unlike aerospace and motorsport, where we have yet to convert a reference client, obviously we've already got torque sensors in military helicopters and in racing cars, but we haven't yet got them in a commercial electric drive, then we expect the lead into this marketplace to be somewhat slower. However, the simulation work that we've been doing through a major engineering consultancy this year is demonstrating some very interesting, although quite specific benefits of SAW technology. And we're not in a position to talk about these in the public domain yet because they will be subject of additional patent applications, which will clearly be good news as far as the long-term strategic value of the company is concerned. I think there are some very significant opportunities for us to expand the breadth and depth and longevity of our IP portfolio in this area. And we will be spending further money over the next 12 months, somewhere order of magnitude £200,000 on developing a demonstrator test rig and obtaining data to be able to back up the claims that we are going to be making in this marketplace. Again, it's going to be a very significant marketplace for us. We think there's an addressable market of upwards of $50 million by the end of the decade. So, there's a very big prize to be won here. In the short term, there are near-term revenues from several funded feasibility projects, and I'll be putting some numbers to that shortly, which are typically in the sort of £25,000 to £100,000 range, which will be contributing to revenue in the next couple of years. So here's the numbers I've been promising a couple of times. People may well have seen this table before in previous presentations. What this table does is records the number of customer engagements according to the number of customers who are all pre-qualified. So they've already been through our pre-qualification process. There's a lot of other potential customer engagements that didn't find their way onto this chart for whatever reason. But as you can see, the number of live customer engagements has moved from 24 to 57 over the last 12 months, so very substantial growth. Out of those, the number who are actually paying for development projects has doubled from 6 to 13. And looking further down in the aerospace sector specifically, the number of aerospace clients has doubled from 7 to 14. And there's been an increasing depth of engagement with those. Almost half of them within the next few weeks actually will be paying for development work as well as being engaged in conversation with us. So some very real progress in terms of the depth of engagement and the number of customers that are now actually paying for development work rather than simply engaged at what we call stage 1B. I'm now going to pass to Melvin, who's going to take you through the financials for FY23 and talk a little bit more about iTrack specifically. And then I will come back and talk about prospects for the business and the midterm financial goals that we're setting for ourselves for 23 to 28.
Thank you, Nigel. Firstly, before I go through the slides, some comments regarding our performance. We've completed our third year of trading following the completion of the licensing deal with Bridgestone. In each of those years, we've faced different external challenges: COVID, Brexit, chip component shortages, and currently the economic issues faced both domestically and globally. Notwithstanding these challenges, this is the third consecutive year we have met or exceeded market expectations. And during this calendar year, the share price has risen by nearly 16% before today's rise, compared to the all-share AIM index, which has fallen by a similar sum in the same period. What is even more important in FY23 is that we achieved the market numbers despite a negative variance between expected and actual royalty income. The fact that both our SourceSense and TransLogic business sectors performed far better than market expectations is a factor that will be significant looking at the future success of TRANSENSE. For the first time in my 15-year involvement with the company, I can confidently say we now have a leadership team that can finally see us realizing the true potential of both our controlled businesses. Ian German has again provided an excellent research note through Allenby covering the next 2 years, and this shows the expectations of continued strong revenue growth in all segments, with pre-tax profitability of the company expected to double again and exceed 2 million by FY25. Looking now particularly at the slide, you can see that revenues are up by 34%, and I'll talk more on this on the next slide. Margins have increased from 85 to 87%. Included in that is an improved margin with TransLogic. OPEX is up only a controlled 6%. In FY24, the market numbers will reflect some new personnel to be added to both SourceSense and TransLogic teams to facilitate our continued growth in both segments. Exceptional one-off costs were around 220,000 and related to restructuring at managerial and directorship level to reflect the changing emphasis towards new business development. Adjusted operating margins were 31% compared to last year's 11%, and these numbers resulted in a fourfold increase adjusted profit before tax and earnings per share rising 79% before exceptional admin costs. These numbers give us a PE ratio based on the adjusted profit after tax of around 10, which the board considered to be on the low side when looking at our growth prospects, and certainly supported by the 2 share purchases that were made today. Segmentally, let's move to the next slide. Segmentally, again, we see improvements across the board with TransLogic up 18%, crossing that 1 million threshold that I predicted last year. I've previously talked about ceilings on the potential TransLogic revenue. However, in the medium term, I see no ceiling on revenue, and Nigel will give more detail shortly. SAW grew by 145%, albeit from a low base. However, as Nigel has just explained, the level of real opportunities has doubled in the year, and the potential for further growth is clear to see and reflected in the research note. Finally, iTrack, despite a slow start, was up 29%. Segmental profit before tax, you'll see TransLogic up 19%, iTrack up 30%, and another indication of the growing success in SourceSense, their adjusted loss reduced by nearly a third. As a result, the loss when excluding iTrack income reduced by a significant 76%, and in some months during FY23 were actually profitable. Moving on to iTrack. Now, this is quite a complicated graph, and some of you will be familiar with it, others it's a new graph. So let me just quickly run through and explain what this graph is showing. So firstly, the axis on the left is the sterling numbers, and on the right is the dollar numbers translated at 125, being the dollar sterling rate at the inception of the Bridgestone deal. The horizontal lines represent the market expected numbers for each year, and the red and blue lines represent the annualized monthly run rate in dollars in red and sterling in blue. Finally, the arrows indicate the actual iTrack turnover for each completed year, which is at the head of the arrow. We show both dollars and sterling, as the former is the currency we are paid in, and of course sterling is the currency we report in. So what are the observations? Firstly, looking at the red and blue lines, you can see that in around 2 of the 3 years covered, the dollar has outperformed sterling, thereby reducing our expected income. We have successfully hedged against these fluctuations in FY23. However, the hedging doesn't impact the turnover of iTrack, it only improves the cash receipts. Clearly, the earlier the sterling blue line crosses the horizontal line, the better chance of achieving or exceeding market expectations. So over the 3 years, we interestingly see a different trend each year. Focusing on the sterling, year 1 saw moderate growth, with sterling crossing the horizontal line round about month 10. And notwithstanding the steep growth towards the end of FY21, the arrow fell just a little shy of the market number. Conversely, FY22 started strongly, crossing the horizontal line in month 6, and despite the slowdown in H2, we exceeded our market number. Looking at FY23, we saw a very sluggish start to the year with some substantial growth in Q4, but only crossing the horizontal line in month 12, hence the shortfall. The closing run rate was 2.25 million. However, when converted at the current FX rate, this becomes 2.38 million, reflecting a strong dollar post-year end. What has been consistent in the annual average growth rate in trucks producing royalties is that each year is just, and the only difference is really the timing difference rather than the actual number of trucks we've increased by. Looking forward, the iTrack market number for FY24 and FY25 reflects the closing annualized run rate and the latest budgeted information we are privy to, which suggests this number is more conservative than the previous budgets, but obviously we have little control over achieving it. The royalty at the end of FY25 will drop to 60% of the full rate, which should be somewhere around about the FY23 number. However, that will be at a time when TransLogic and SourceSense combined are expected to more than take up the slack. To date, this deal has actually produced cumulative income of 4.4 million, and Ian German has estimated in his research note that we should receive a further 13 to 18 million up to 2030. Whilst many who look at the iTrack income discount it due to its finite life, it is important to bear in mind that if SourceSense and TransLogic are, as being projected, profitable in their own right in, say, FY26, then Ian's research note number is worth around £1 a share in its own right. Finally, from me, the cash flow. Let's move this forward. This statement leaves little explanation. We have an excellent operating cash conversion rate at 75% as a result of strong credit control and regular quarterly royalty. We expended a further 404,000 on share buybacks at an average price of 88p. The total now is 707,000, with the average price paid just under 80p, which is 25% less than the latest mid-price. Finally, the year-end cash was marginally down on last year. However, the post-year-end royalty receipt was 585,000, which, going back to the comments on hedging, included a 50k gain on FX. I will now pass back to Nigel to talk about the future prospects.
Thank you, Melvin. So first, I'm just going to talk a little about expanding on what Melvin said about cash generation. I mean, our trading outlook indicates a continuation of very strong cash generation. And as Melvin's mentioned, we have used a significant proportion of last year's cash flow on share buybacks. We see many opportunities to invest in the business, particularly in the SOAR technology. We see opportunities to invest, as I've discussed, for example, on the electric motors and drives demonstration test rig data. a pound spent today, we think will offer a very good return in terms of strategic growth in that business. And so, we will be making sure that we retain and generate sufficient cash to be able to meet those investment requirements, and particularly to recruit further engineering resource who will be customer-facing people who can accelerate the commercial delivery and the technical development of our technology. However, we still expect to continue to see sufficient cash flow to be able to return money to shareholders in the future in the way that we have in the past. And we have consulted widely amongst the shareholders over the last 12 months to tease out what the relative benefits of buybacks and dividends are in the hands of shareholders. And we have concluded overwhelmingly that both by number and by value, shareholders see that buybacks offer much more flexibility and tax benefit, and consequently a feeling that that is the way for us to go as a means of returning funds to shareholders. We will, however, also continue to build strategic cash resources. There will be plenty of opportunities for us to invest in the business also, and that will always be the first call on our cash. Let me turn next then to current trading. Revenue in the first couple of months of the year has continued to show growth over the prior year. Revenue for July and August was 16% ahead. In TransLogic, we've added an experienced business development leader, as I've already explained, and have some very exciting opportunities. We think that that places TransLogic in the driving seat as far as being the primary top-line growth provider over the next 5 years. We think that it's going to be a very exciting journey, and look forward to talking about the delivery of that in the next few years. Meanwhile, in TRANSENSE, there's been a very rapid expansion in market awareness. We're seeing 2 or 3 inbound inquiries per week at the moment, some of which pass our qualification criteria, some of which don't. But new qualified sales leads is at a very high number there at 57. And also the increasing intensity of those in terms of projecting those up our table and into paid development projects is growing all the time. That's what's driven revenue up by 146% in the current year, and we expect to see that continuing to develop significant growth in the top line, including the numbers which are in the Allenby forecasts. We are also seeing investment opportunities to add depth to the IP portfolio, as I've discussed. So TRANSENSE is very much going to be a self-sustaining business, and that will happen prior to full commercial deployment of SAW technology, which is likely to take somewhat longer. In terms of iTrack, again, as Melvin has explained, the prospects are very much underpinned by the deployments that went into place and strong growth in the second half of the current year for FY24. And if I just look at where that leaves us in terms of midterm goals, what this table does is essentially look at the historic 20 to 2023 in the left-hand column, where has our growth come from. It then in the middle column shows where we see midterm growth prospects for 23 to 28, and then longer term prospects in the right-hand column. Looking first of all at TransLogic, it's delivered compound annual growth in revenue of 15% per annum over the last 3 years. Yes, that's good. But looking at 23-28, we see significant step changes in that now. It's coming still from a low base, and we think there's lots of opportunity to grow that revenue much more quickly and see it become do the main heavy lifting in terms of company revenue growth. And longer term, it's a $25 million market there to be attacked. We see lots of growth potential in the business from the base that we have now. Turning to TRANSENSE, primarily the activity over the last 3 years has been mostly non-revenue generating technical and commercial evaluation work, both by our customers but also by ourselves in deciding how to position our technology and in what sectors to attack. Over the next few years, all of that work is going to be funded. There will be funded development work going on across all of our key target market sectors. We think the business will be financially self-sufficient and start to eat its own kill. It'll be generating more revenue than it's costing to provide the services that we currently provide. And we'll be building a very exciting pipeline of sustainable long-term business, which will be harvested in the post-2028 period. And we've identified across our target market sectors many opportunities to develop millions or tens of millions of revenue towards the end of the decade. Turning to iTrack, it has been the major driver of growth in the historic period. We've seen annual step changes. We still expect to see good growth in the next couple of years in the iTrack royalty. 15-20%, sort of high double digits is a sensible sort of growth target for that. But it was likely to peak in the year ended June 25, when the royalty rate per installation starts to fall. And by 2026, it's likely to revert to the 2023 level. However, as Melvin has said, the growth prospects in the rest of the business will be such that we expect to at least maintain earnings in 2026 compared with 2025, which in turn is double the level that we've reported for 2023. So, we think that that's an excellent return for shareholders. And going beyond 2028 and looking at life beyond 2030, then after the expiry of the iTrack royalty, we think that we're going to be left with two very strong and growing businesses, which are well capable of taking the company through the targets that we've set. So, overall, I hope that it's conveyed that the directors are very confident of the future for the business. I'm going to pause now and pass over to Tom. I think, Tom, you can perhaps help us with any questions that have come in.
Indeed. Yeah, thank you, Nigel. Thank you, Melvin. We have a number of questions, however, please do continue to submit your questions using the Q&A tab situated on the top right-hand corner of your screen. Additionally, your feedback is important to the company. So immediately after the presentation has ended, you will be redirected for the opportunity to provide that feedback. Now, if we could start, Nigel, with you, just looking at inquiries and prospects. We've got a couple of questions which hold together relatively well. Andy asks, what visibility do you have on new customer projects? And if I could just maybe you could combine that with a question that Tim's asked, which was that the company appears to have received a large number of SAW inquiries. What are you doing to convert these inquiries into deals? So there's a bit of a life cycle question across both of those.
Yeah. So let me just talk about how the cycle works. So initial inquiry would come in generally now because a customer has identified an opportunity which they believe that SAW technology might be able to address. Often it's a problem that needs to be solved, or it's a saving which they want to achieve. And so that inquiry would come in, and our initial vetting procedure would make sure that it was a credible inquiry, credible company, that we're able to talk with a decision maker, that they have a budget allocated, and that we want to actually dedicate resource to servicing that inquiry. And a number come in where we feel that there either isn't a technical fit or a commercial fit, and they are, politely declined at that stage. Those that get through into our system find their way onto the table that we've shown a summary of. The summary table there is actually an extract from our internal customer relations management, or CRM package, in which we track those inquiries through our systems. And initially, there would be a two-way exchange of information, usually under NDA rather than publicly available information, to address the customer's questions about our technology and determine whether they wish to actually take that forward into a feasibility project. And so out of the 57 that we're currently working with, there's sort of mid-teens number that have progressed beyond that to say, actually, we are looking at a development project in which we want you to instrument, usually instrument a shaft, not always a shaft, but usually instrument a piece of our equipment so that we can actually start to read the torque measurement or temperature measurement, or whatever it's being used for, and determine whether that data has use to us. And those projects would typically be somewhere between £20,000 and £80,000 and would have a duration of somewhere between a month and 3 or 4 months. Here's the frustrating bit. They're all big companies. it can typically take 3 months to get onto their supplier program and be approved to receive a purchase order. And despite the fact that the engineer we're dealing with is desperate for the work, it can often take a couple of months for the purchase order to arrive. That's life in big companies. So, can that sometimes be frustrating? Yes. Does it actually change our life in the very long term? Well, no, of course it doesn't. But progressing through that stage can be somewhat slow. Our main objective at that point is to make sure that in that game of tennis, the ball is always on the other side of the net. We're extremely quick to deal with any information requests or any paperwork which is necessary in order to be able to process a purchase order. Once that project's been completed and the data is available to the customer, they'll then make a determination as to whether they think that they want to take it forward commercially or not. And assuming that they do, then that will give rise to a lot more engineering effort and then later supply chain effort to be able to provide the technical support that's needed to prove the technology and to productionize the technology, and also to provide a supply, a reliable supply of components. So, that's going to be the work which will be chargeable over the next 3 to 5 years, which will, increasingly be in hundreds of thousands rather than tens of thousands per customer, and will ultimately unlock the door to full commercial production towards the end of the decade.
Great, thank you. And following on the theme of supply chain, Simon asks, what steps has the company taken to ensure supply chain resilience?
In terms of general electronic components, we've had to buffer some stocks, which we've done in order to be able to keep a safety stock of long lead time components. That's particularly on the Translogic side of the business. And I've also been able to obtain support from colleagues in other companies as well. A nod to my colleagues at Solid State for some help that they've given us over the course of the last couple of years. Not only ourselves, but for Bridgestone iTrack product as well. They're an excellent supplier, and that sounds like a commercial, but there you go. In terms of supply chain for SAW, then it's obviously very specialized. There's a relatively small number of potential suppliers, particularly for the AQP product, but we have very strong relationships, and wherever possible we dual source rather than single sourcing components. Again, we hold high stocks ourselves. They're relatively low cost components, so it makes sense for us to hold high levels of safety stocks to be able to support development activity, even over a sort of 18-month period forward. It's quite low cost for us to buffer the stocks to be able to support that. But, always be mindful that we will need to provide a reliable commercial supply chain when things go volume in the future.
Great, super. Two questions I'm going to put together. They're both on revenues and potential licenses. James says, how do you see the mix of SAW's revenue evolving in the medium to long term, as between engineering / consulting revenue versus license or royalty revenue? And Brian says, you've talked about the potential revenues for upfront license deals. What is your thinking on that?
Yeah. They're really insightful questions, actually, because if you look at, for example, the T901 program with GE, then we received $750,000 up front in licensing income. And we always expected to be involved in the supply chain as well, to be providing both technical support and then ultimately components also. But it was assumed in that license that GE would be able to source components themselves independently. And actually, they found that quite difficult to do. And I think that speaks to our business model, actually, that taking upfront money for licenses early is obviously quite seductive, particularly if you need the cash, which in 2016 we did, but now we don't. So, it may be a smarter play for us to play a longer game rather than cashing in early on a license which provides a customer complete freedom where to do their shopping in the future under the license. It might actually be strategically smarter for us to work in longer term partnerships where perhaps upfront license fees are either lower or work in a different way, such that actually customers enter into a long-term engineering and supply contract rather than necessarily licensing as a standalone. So, that's probably not a very crisp answer to the question, but I think it indicates that our thinking is very flexible, and that actually different customers will benefit from a different model, and ultimately that will be the best way to deliver shareholder value.
Okay, and on the share buybacks, we do have a number of questions actually, and if I can possibly combine a couple and you can answer those. Gareth says, and I'll praise it slightly, you've purchased shares equivalent to almost 6% of the share capital. Why have these shares not been cancelled? That's his question. And Brian's question is, I understand some would prefer share buybacks over dividends, but if we don't have any sellers, then how does it work in practice?
Okay, well, I'll answer Brian's question first, if I may. So, it's an open market. There are always sellers, sometimes small, usually small. It's a pretty thin trading market in our stock because we have a lot of long-term major shareholders. But nevertheless, there is still daily trading. If you look at the share purchases by the company, it hadn't taken us very long to accumulate those shares, and in parallel, people have been following over the last few weeks that Dowgate Capital have been acquiring shares for one of their portfolios. They made that decision only a few weeks ago, and were able to accumulate 4% through very patient buying of retail stock in the retail market. So there is always transaction volume. If there were ever any large sellers or buyers, then the company's brokers will be able to help. But in the meantime, the retail market does still offer opportunities to accumulate stock if that's what buyers want to do. If there are no sellers, then there will be upward pressure on the price, and if there's upward pressure on the price, the company's unlikely to buy shares back anyway, because we'd prefer to see the market functioning effectively, and the instructions to our brokers, which are standing instructions, which we can only change when we're not in closed period, I should say. Those standing instructions mean that they won't bid the price up. They will simply pick up stock if the market is overweight. I'm sorry, can you remind me the other part of the question, Tom?
The other part of the question,
why have they not been
cancelled?
Yeah. The company has issued share options to all of the current employees, including the directors, and those share options represent a 10% dilution. So at least until such point as there's 10% in treasury, then it makes sense to retain those shares in treasury and be able to use those to satisfy options in the future if they become exercisable. And although they have different criteria, the major criteria is the share price needs to pass the £1.50 threshold in order for those options to become exercisable, which in broad terms represents a doubling of the share price since they were issued. It's a bit more nuanced than that, but broadly speaking, that was the performance criteria.
Okay, and you may in part have answered the next question from John, which is, what is the point of being listed on the AIM market? You have undertaken share buybacks and imply going forward you have sufficient cash to fund the business. Why incur the costs of a public listing?
Brutally honest answer, John. We probably wouldn't start from here, but here we are. There would certainly be an appetite amongst the management to take the business private, but I think it would be very difficult to find a price to do that would represent fair value for the shareholders. So I think that although we don't need to raise capital on the AIM market today, one would never rule out the possibility of doing that in the future if there was a major opportunity that required funding. And I possibly have ruled it out in the past, but I think we're in a different place now, and I wouldn't necessarily rule it out in the future. But I think the honest answer to the question is the company is a listed company because it's a listed company, and it makes more sense to stay where we are than to move anywhere else. But if we were a startup, we probably wouldn't start from here.
Yeah, excellent. Melvin, one for you. Gareth asks, have you considered hedging your US dollar exposure in view of the high proportion of revenue coming via iTrack royalties?
Yep, thanks for that question. Yeah, as I mentioned in my presentation, we have actually hedged We started hedging in FY22 and we continued that through FY23. Interestingly enough, you speak to lots of people, get different opinions on where the dollar/pound's going to be. Taken over the 8 quarters in 22 and 23, I think the overall net position was we're up about £20,000, but it is very hard to judge. But we do definitely hedge, and we generally use 125 as our point of hedging because that was the rate when the deal was originally struck.
Right, super. Thank you very much.
I've said for my entire career that no matter where it is today, the dollar will always be 140 to 160 in the long term. But I'm actually doubting that that's true now post-Brexit. I'm not sure we'll ever be worth that again. But there you go. That's a personal opinion.
We'll save that for the last question, which I'm holding. But yeah, so John also says a small company, but the directors could own much larger stakes if the prospects are so good, ?
The directors could own much larger stakes. Well, you know, we've all been buyers. You know, if you used a standard benchmark, excuse me, sorry, I should say I had minor surgery this morning, not a fight. If the standard benchmark is that the directors ought to own a year's income, then you know, I've got 5 years income in TRANSENSE invested in the portfolio that I've bought, all in the marketplace. You know, I have 265,000 shares. I've bought more than 2/3 of those since I became executive chairman post the Bridgestone transaction. I don't think anybody would doubt my commitment to this business. You know, all of the directors from time to time have bought and will continue to do so when there are opportunities around and the price is right. I should say as well, for large periods of time, we're all prevented from buying because we're often in possession of price sensitive information. So if you look at the share price low of about a year ago, it was 47p at one time, and we were all absolutely gnashing to buy. But unfortunately, we weren't afforded the opportunity because we were in negotiation with Parker Meggett about the MOU.
Yeah, okay. Final question, and you may wrap this together with a little of your own view on macroeconomic issues as well. But Nicholas asks, lots of positives in the business right now. What do you see as the greatest risk to the execution of the strategy?
Okay, greatest risks. Macroeconomics, I actually think isn't, although I am pretty bearish about the macroeconomic outlook. But I think that is unlikely to materially affect the prospects for TRANSENSE. And the reason for that is the nature of the work that we're doing is such that I think product development and R&D will probably continue in the aerospace and automotive arena through a downturn. I don't think that's the area where costs would be cut. I think there's always going to be a need to innovate. And I think that our offering in TransLogic is very much a cost saving measure. So when times are tight, people are likely to want to save money and will buy the tools to do that. iTrack, I think, again, you know, is very well placed as a cost saving tool. Although, you know, in the commodities, if the commodities boom comes to an end, then mining volumes may decline, and that might put a bit more pressure on conversion of new business for Bridgestone. So I don't think macroeconomics is a major threat. I think that makes us actually a very attractive investment from a defensive viewpoint, because I think that a lot of our income is already baked in and you know, fairly secure, even if growth is harder to come by than perhaps we anticipate today. So I mean, the biggest operational challenge in the business is the recruitment of people. And I think that's common right across the industry. You know, there are good people available, but there's still more jobs than there are people in engineering. You know, again, I don't want to get too political, but restricting people from coming into the country who are very highly qualified and experienced is not helping, because it means that, you know, we have a much smaller pool of available talent than we would otherwise have to be able to recruit people if free movement of people isn't available, and that's just fact, not politics. So, you know, the single biggest operational challenge today is hiring engineers. in order to expand the business. Although we have what we need now, and we also have some good countermeasures in place in terms of being able to use subcontract or contracting in people. Outside of that, I think, there was, I forget who it was to give them credit, but I think that, the resilience of the supply chain is always something that we need to keep very close to, because our product, our technology is dependent upon components which are actually designed to be high volume, low cost. And whilst we're in a low volume, high cost environment, before we make large scale commercial breakthroughs, then we need to keep our supply chain engaged and interested in what we're doing in order to be able to be a robust supply chain in the future when we're out of development phase and into commercial production.
Great. Okay, thank you very much indeed. Thank you, Nigel. Thank you, Melvin. Could I ask investors not to close this session, as you will now be automatically redirected for the opportunity to provide your feedback. If anyone has further questions or would like additional information on TRANSENSE technologies, please do get in contact via transense@walbrookpr.com. Many thanks for attending today's presentation.
Thank you. Thanks, everybody.